Putting more money down doesn't always automatically mean you're making a better decision. One of the biggest misconceptions I see, especially with financially responsible buyers, is this idea that the more you put down, the safer or smarter your purchase is. And while that can be true in certain situations, it's not universally true. Because when you are buying a home, you're not just making a purchase, you're making a capital allocation decision. You're deciding how much liquidity to keep, how much to deploy, and how to structure that decision over time. And most people skip that part entirely. They default to, let me just put 5% down or 10% or 20% down if I can, without ever asking what actually makes sense for my situation. The down payment isn't about the property, it's about your position after you close. So the real question isn't how much should I put down, it's what position do I want to be in after I buy. So 0% doesn't mean you're paying nothing. It means you're structuring the deal differently. When we talk about 0% down, typically we're talking about VA loans, sometimes maybe USDA loans, but what makes the VA loan unique is the no down payment requirement, right? No PMI, but there's a funding fee that gets rolled into that loan. So instead of putting cash up front, you're financing more, but you're gonna keep your liquidity intact. Now for some buyers, that's a massive advantage, but because instead of tying up, $15,000, $20,000, $25,000 down, you're able to keep that capital available. And depending on situations, that you could use that to buy furniture instead of financing it, you can buy it cash, etc. Or if you get better returns, investing in the stock market or wherever, every situation is going to be dependent on each individual, right? So that's not cheap, that's strategic liquidity management. So the big takeaway is the 0% down isn't about avoiding cost. It's about deciding where that cost lives, either upfront or inside of a loan structure. So 3.5% is where a lot of buyers land, but very few actually understand the benefit. With FHA, you're putting 3.5% down, which sounds reasonable. It lowers your loan amount slightly, but it introduces something different. Mortgage insurance premium. And unlike conventional PMI, FHA MIP often lasts much longer, sometimes for the life of the loan. So now instead of preserving all your cash like VA or avoiding long-term insurance like 20% down would, you're in the middle. Some cash out and a monthly recurring cost. 3.5% down is where a lot of buyers land, but very few actually understand the trade-off. What I mean is with FHA, you're putting down 3.5%, which sounds reasonable, but it may lower your loan just a slight amount, but it introduces something different, and that is mortgage insurance premium, or MIP. And unlike conventional PMI, FHA MIP often lasts much longer, sometimes and most often for the life of the loan. So now instead of preserving all of your cash like VA or avoiding long-term insurance like putting 20% down, you're in the middle, some cash out, and a recurring monthly cost. This is where people get tripped up because it feels balanced, but it may not be optimized. So FHA isn't just a starter option, it's a structure, and you need to know what you're committing to. 5% looks a lot cleaner on paper, but there's a trade-off that most people don't think through. With conventional loans at 5% down, you reduce your loan amount, show a stronger borrower profile, and potentially improve your terms, but you still have PMI, which can easily run $100, $150, $200 per month, depending on your profile. And that's not a one-time cost. That's a recurring monthly drag. So now you've done two things. You've used your cash and you added a monthly obligation. That doesn't mean it's wrong. It just means that you need to be intentional. The real decision isn't the down payment. It's how you pay over time. Let's simplify this. The VA loan has a higher loan because of the funding fee. The FHA loan is more moderate down and long-term MIP, mortgage insurance premium, and conventional, that's a lower overall loan, but it has PMI. So your decision becomes upfront cost or ongoing monthly costs. And this is where the strategy lives, because over time, these small monthly amounts can compound significantly. So $150 a month doesn't feel like much until it's 150 times 60 months or 150 times 120 months. So don't just compare the loan, compare the timeline. The biggest mistake I see about loans is about ignoring cash position. So where do you put the money down? You're doing two things with that. You're lowering your loan and reducing your liquidity. And for a lot of buyers, liquidity matters a lot more than a slightly lower payment. In real estate and honestly in life, cash is king, right? Cash equals flexibility, and flexibility equals control. So the question now becomes, do you want a lower payment or do you want a stronger position? And don't get me wrong, 0% isn't always better. You know, I do love leverage, but in certain situations, it clearly wins. 0% down tends to win when you want to preserve cash, you have an investment opportunities that can give you better returns, or you have liquidity over marginal payment reduction, and especially when there's no PMI involved, like the VA loan, which again is a fantastic loan. So this isn't about avoiding cost, it's about deploying your capital intelligently. So if keeping your cash gives you options, 0% down becomes very powerful. On the flip side, there are times when putting money down is the better move. For example, if you want to lower your monthly obligations when your budget is tight on payment, when you're optimizing for long-term stability, or when removing PMI is the goal. This is where discipline meets strategy. So putting money down isn't bad, it just needs a purpose. Now, just because you're approved doesn't mean you should use all of it. This is where everything connects. Approval amount, down payment, monthly payment. Most buyers max out the approval, minimize their down, and stretch themselves thin. That's not a loan problem. That's a decision problem. So structure your purchase around your life, not your limit. So really, there is no best loan out there. It's really the one that works for you in your individual case. Now, don't get me wrong, like I said, the VA loan, in my opinion, is one of the best, if not the best loans out there, but it may not work in every situation and not for everyone. Because when you look at 0 down, 3.5% down, or 5% down, they all work, but they work differently depending on your timeline, your cash position, your comfort level, and your goals. So this is why generic advice fails. The right structure is always situational. The difference between guessing and knowing is running your numbers. You can watch videos all day, but until you can actually see your payment, your loan structure, your options, it's all theoretical. So if you want me to run your numbers based on your specific situation, there's a link in the description. As always, no pressure, just clarity.